Okay, the market has been going a little crazy this past week, and I really wanted to take the time to see if I can translate to help some of you understand exactly what does that mean and what should you be doing with these reactions to the market when it comes to your retirement, your investments that you do have. Both the stock side as well as the crypto side has been affected. So let's take a look.
Hustle, 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 step. Move, and make it back. First we gotta hustle, hustle, so we get the cash.
The first thing we want to look at is kind of like, when did this start happening? As we can see, literally from last year, and I'm looking at the Dow Jones from my phone right now. As we can see, look at the 1 year mark from last year. There has been a start of a slowly rise, and the decline started happening around January. A lot of stocks were already tripping and taking little faults here and there. So it was pretty shaky. But whenever you see this up and down motion, people are unsure. What happened is you're having a bull slash bear market, as they describe it. Pretty much what happens is people are buying, people are selling, and there's not either one going on either side. Like, there's not more people buying, which is what makes the market go up. There's not more people selling, what makes the market actually go down. But we can see in January that the decline started being much more towards the selling side. That's what they call the bear, right? Part of that, we know around that time is when the whole war started happening. Oil prices were starting going to the roof. Inflation, we knew, was already rising up. The minute you have a lot of money being printed, which the government did in 2020, 2021, there's a lot of cash that's made up. So that's more cash, more supply. Of course, the value of it is going to come down in the US at least. But with the oil prices just like shooting up in the way it is, and we see groceries when we go to the supermarket, all these things are just rising up. Even I myself right now, I'm experiencing this a bit with my gas prices that I use to heat my home. I remember the highest bill I've got is the highest I've ever gotten it, but I look at the rate that they're charging and it's like almost double. The water price has also increased. These things are happening because of inflation. They have to keep up with the value that they're providing you, so that way their companies can keep flourishing whatsoever. So therefore they pass it on to the consumer, which is me and you, and our prices, our cost ends up going up, or cost of living, and we see rents going up. All these things are happening. But what should you really be doing as well to keep up with this? Because there's so much ways we can look at this, but we want to be putting some strategies forth. And I'm going to tell you exactly what I'm doing, what I have been doing for the past like few weeks, months or so. For me, on the real estate side, because I have rentals, and with my rental, my meters aren't separated for the home. So I have tenants and we're sharing it. So there's no way for me to tell the gas usage. It's not billed to them separately. So it's all combined. What I typically do is find the worst number. So it was about $900 for this year. And I'll factor in the difference for what it was in last year. And I kind of divvy it up to see how much I'm going to increase. But because right now things are so high, things are getting much more expensive, there's no room for me to cut back. I usually try to find ways to cut back so that way I'm not passing it on to my tenants whatsoever. But however, with the prices just continuously increasing, it didn't give me much more of a choice. I didn't have that leeway, that luxury that I had from before. So that's one of the things that I've done. And this goes across the gas and really water, because those are the only two things that really went up. If you have a new unit, a new rental, you're more in luck because you get to establish the market value. I typically go for the average market value, not the super high, at the same time, not the super low, because I am providing certain qualities to my units. I have Wi-Fi included, wash and dry included, plus you got the gas, the water. There's a lot of things that's not being paid for separately. So therefore, my average price is what I usually stick to. A lot of places, you got to pay for all these things separately on top of whatever they're charging you. Since we're on the real estate side, actually last year in December, I also tried to acquire another property. It was a commercial unit. It would have been a good deal. However, things didn't quite pull through the way I desired. I seen the place. It didn't need that much work per se. I actually did the inspection, but there's a lot of uncertainties, and it came up to about maybe 20, 25 grand of uncertainties. So once I had put in the offer, I told the seller this is how much I would want inside of it for repairs. You send that to the attorney, so the attorney is the one that actually ships that out. But then they came back and stated that this is now an as is sell, which was never on the listing at all whatsoever. So that's really what pulled me away. The property was good value. The rental I could have got for it, because it is commercial, would have been higher. And I checked in the area. It was actually in Trenton, New Jersey, an area that I started exploring and tapping into. I went there a couple of times just to see what the neighborhood is like and what's evolving. And it seems like it's slowly getting there, but I think it caught my interest because of the price and also the value that I was able to get. So the mortgage was going to be, in the worst case, with utilities and everything, about $3,000. And the average, I would say, of what you can get for commercial, in probably like the worst case, was, for the size of it, was about 4,500. So I would have netted 1,500 at least in the worst case. And in the best case, it was going to be at least like 6,000, 6,500, which I would have doubled my cost, which is what we want to shoot for. Regardless, it felt like a good deal. But however, with some of the immediate things that needed to be fixed, I didn't want to do that. And also the gas wasn't working at the time that I did the inspection, so I couldn't see if the heat was working. They had HVAC system in there. A lot of the building was pretty great. It had parking downtown, right next to the courthouse, not too far away. It was in a good location. However, it didn't fall through for me. I have no regrets. It's just one of those things you learn from and try to get better. But I really feel that me and the seller, we have to kind of see eye to eye. We have to be able to negotiate, because I did go into a deal before where I tried to get my first home, and home was quite a bit of a wreck. And I had asked for about 10 or 15,000 in credit. It initially went from 50, but I brought it all the way down to 15, and they kind of agreed on it verbally after some back and forth. And then when it came time to move forward, they never sent the paperwork. I waited a few days, nothing, no response. And I wasted all this time, all this energy, or doing all this inspection. They did not fall through. So one thing I learned from that situation is, if the seller is not willing to kind of meet you and understand that this is a dual business transaction, that it's not for me. But at least that's just for me. One day, maybe once I see that, the cash is not really a big of a deal in that sense, because 20, 25 grand is not that much. I've done repairs for in a couple of weeks span, and that's how much I spent. So if it gets to that point, then yeah, I think I would have probably went forth with it. But for some reason, my gut feeling was telling me this is not it. The seller should be willing to find some compromise, because it might create more headache for me down the line. So I definitely killed that. I did have a lot of the cash liquidated at the time. I had an equity payout that was made to me, so I had the cash available. I didn't have to sell any stocks or whatsoever. I already did kind of do some sales of stocks and some crypto earlier during the year, because I wanted to get some stuff done. However, I didn't do any more liquidation. That money was already liquidated, sitting there. That's what I was going to use to do the transaction. But because I saw the market started declining and I wasn't going to do this purchase, so what do you do with that money? So what I did was I set a certain amount that I was going to set to retirement. And also the other half portion of it, I used to pay the taxes that I owed, because I did owe a bit. I mostly worked the year as an independent on a corp to corp basis. Therefore, they don't pay your taxes for you. You're responsible for your own taxes. So I just paid it pretty much with the other half. So with the one that's in my retirement is where it's key and crucial, because I had all this cash sitting there. I wanted to be very strategic about it. I didn't want to just go in because it's just there and just buying. It's just finding that right time. And if we take a look, we can see when that right time was. And we could look at actually any of them. Let's look at the year to date actually, because it starts from January. As we can see, there's a decline, right? The Dow is down 11% year to date. Right now, of course, good time to buy. I would definitely suggest it. But if you're putting money in, it's a great time to buy. Let's look at NASDAQ year to date. 25%. Huge down, but it has a bigger upside if you were to buy that fund. But I just look at all of them on an average basis. Let's look at SP 500. It's down 15%. So the average of that is about what 50? Yeah, about 15%, give or take. So those are the numbers I look at to see if it's a good signal for me to get into it. So if the indices are down, let's look how stocks were doing. So I know I have quite a bit of stuff on here. But let's look at a general stock. Let's say Amazon, and I have quite a bit of stuff on my watch list. Let's see if I can find Amazon. Actually, it's quite a bit of search. There we go. All right. So what has Amazon been doing year to date? So they're down 32%. Right. We see that they're down. Another common stock I can look at. This one I have quite a bit of as well. But let's look at Netflix. What happened to Netflix? It's down 61%. Well, with Netflix, the reason that they are down quite a bit large too is partially because of the unexpected like user growth. If you look at the day that they actually released their news, their user growth dropped from what was expected. So investors, oh, we're gonna sell whatever. But honestly, this was one of the moves that I made for both my retirement as well as my health savings account. So right now, because the market is down, right? These are your indicators or the stocks that you want to buy, or they down. And then or also the indices down. Because if the indices are down and the stocks that you are interested in are down, then it correlates in the sense that it is a good signal to buy. If it's one or the other, you want to kind of think carefully of which one you want to make a move towards. If the indices are down, typically means you should try to get into a mutual fund. One good one that I have, two actually, is this technology fund. If we look at year to date, it's down 30%. I've put in some funds in there before when COVID had that drop, and then I did kind of almost doubled, but then I liquidated. And then the other one is Ario Investor. That one, they're doing pretty good actually because their down is not that much. It's 13% year to date compared to some of, well, as we can see, this technology fund. But the upside of the technology fund is much bigger. So I would put funds in there. The other one is much more for like if you already have a large pool of money and you don't want to see it fluctuate. Of course, this one is a much safer bet. But I look for the upside right now because I'm trying to get the max growth as much as I can. So if you have a 401k or any retirement plan right now, great time to just transfer as much as you can over. I worked at a company before, and when that trade war was happening in 2018, when Trump was going back and forth with China, etc., right? The market was plummeting quite a bit. And this goes across the indices as well as stocks. And let's see if we can take a quick look how that looked, because it was pretty ugly. I remembered. This was like 2018. I think, yeah, this was like around this time. So it was like, so we're looking at NASDAQ. So it was peaking like 7,500 and it went down to like 7,000. Because I was definitely around that time. And look at this dip as well. It went from 8,000 all the way down to 6,300. And when that happens, it's like almost 2,000 points down. You want to get in. So what I did during that time is I maximized my contribution. They allowed you to offset how much you wanted to put per pay period. So the luxury about that is that it's not always a fixed amount. Like it's not like 10% across the year or every paycheck. I can go in, literally say, for now, since I see the market is down, I want to put 35%. That's what I did. They let you put a max of 35% of your pay. And this is your gross pay, not your net, your gross before taxes that you can put aside, because that's the first thing that they minus and deduct first. So I did that, contributed that, and then my returns was great. My returns really, I saw them during that rebound after COVID really spiked up. So I think I might have had contributed maybe around 40 or 50 grand in total, and it peaked around 110. So it's like 2 times. No, I think I contributed less, honestly. So, but it definitely peaked like 2 times plus than what I actually contributed inside of that retirement account and such. So there is a huge upside as well whenever you're seeing that the market is dropping like that. You just got to be patient and make the sacrifice. I know it's hard because when they're pulling more out of your 401k, you get less cash to you. However, the advantage part is that you're getting taxed less. The cost of you keeping cash inside of your pocket and not putting towards your retirement, it costs you more money because you have to give more to Uncle Sam at a higher percentage. But if you end up putting more towards your retirement, your taxable income becomes less, meaning you're getting taxed at a lower percentage, which means it costs you less money to be able to actually put money inside of your retirement. So technically, you kind of have more money. Even though when you get retired, I haven't reached there yet. I'm sure it's going to be amazing. And I'll have to figure out exactly how I'm going to withdraw money slowly and slowly without paying the taxes on it. Because you do have to pay the taxes when you do the withdrawal after you completely retire. But you can always offset your taxes, right? If you got property taxes and all this stuff, these are things you gotta do. Rental properties, you got cost, depreciation costs, and all these things you can put in play. So you can really offset it. And that's why I prefer to put in a pre-tax contribution instead of the Roth side of things. I personally, but I haven't experienced it yet. I'm not 60 years old to experience what it's going to be like to see which methods work. I just did my own analysis to make that assumption. One of the strategies you want to do too. So now, since you are putting that 35% aside into your check during these bad times that's going on right now, or maxing out as much as you can. You may not be able to do 35, whatever you can, or whatever your employer lets you do. And if you're independent, then you have the full flexibility of just like dumping into it. Like I'm independent now. My 401k plan is under Charles Schwab, so I can invest in pretty much anything in the market. But if you're limited by the employer of particular funds, what you want to do is look for the 1 year mark, the 5 year mark, or the 15. Sometimes they may not have the 15, they have the 10 or even the 20. But you want to look at the short term, middle term, and long term, pretty much. So those numbers I'm giving you are just like average. You want to see what they have been returning. They should be doing at least 10 to 15%. If they're not, I would not suggest you invest in those funds. So those funds that are doing like those averages, you want to find the one that has the biggest upside. So if the one that's been doing that, so let's say now your list of maybe like 5 6 funds that's been doing 10% in the 1 year mark, 5 year mark, as well as the 15 year mark. What you want to ensure is find the one that dropped the least. I mean the most actually, that had the least amount of the most amount of losses over the course of, I don't know, the past month, because that's where the market shifted. Like it did a huge drop within that time. That is the one that you want to kind of put like 50% of your contribution towards, right? That 35% contribution you're doing that's going in from your check every single week or every 2 weeks. That's the one that you really want to put like that 50% of those contribution towards. Now, the other 50% that you have, what you should do is distribute it evenly across the other ones. So, what that can be, it all depends. There's no like equal math. You can just kind of go with your gut in a sense, but if you don't want to figure out the math, you could just do an equal split and find like 3 other funds that are doing 10 15%, and you just diversify it across that. It doesn't matter their upside, because you want to just have a diversity in case one goes down, one goes bad, and you have an incline and you're always increasing, because the market is all going to rebound. No matter which of those funds that you pick, it's going to rebound. If the whole market, like all 3 indices are down, it's going to bound to always come back no matter what. So you have no chance of really losing. You just got to play the patience game. You just got to wait. And since it's your retirement, I mean, if you're or in your younger age like I am, then you have quite a bit of years until you actually get to touch and play with that money. Unless you're doing a 401k loan, then that's different. But these are amazing times to just get into the market and try to get as much as you can, because you want to experience that upside. You want to experience when that rebound happens and just be able to look at your retirement and so that there was a huge increase. Do the same thing across your health savings account as well as your FSA. If you don't have an HSA, you have an FSA. Do the same thing. Try to find those funds that have the biggest upside and that has been performing the best, like 10-15% a year, but then it dropped a lot with the market and just put it in towards those funds. Same thing, contribute from whatever you're contributing, take half of those funds, put it in the one that dropped the most, that's been doing the worst, and then the other three that you pick, diversify it, divvy it up across all three equally, and just let that sit there. And over time, you're definitely going to see that rebound and that upside happen. So these are the funds that I actually bought when I put money inside of my HSA as well as my 401k plan. I actually bought all Netflix because the way I look at it is they're not really going anywhere. Yes, their subscriber growth has suffered. I don't know what their future upholds like or what can there be. But however, I know there's a lot of people that are keeping their Netflix subscription. They're not really being impacted in any way, shape, or form by what's going on. So, and I see it as a smaller drop. Like it did drop. And I bought it on average about 195 a share, both across my retirement, individual retirement, as well as my HSA plan. And I'm just going to sit there and wait. Right now, the day that I'm actually recording this, it dropped. It dropped all the way to like 166, I think. What am I going to do? I'm not going to sell it. I'm going to wait and see because I think there's a huge upside with it. I think it's just going to keep going up back to its price that it should normally be at. And that average price for me for Netflix is around $300 a share. I think that it is its stable price, like its normal price. Then anything above that, I would consider profit. That is just based upon my own analysis of how it's been performing and how much like cash it has, how much revenue has been bringing in. I think around the price of $300 a share is like their average. And if they're doing good, it should definitely be higher, much higher than that. So these are my list of stocks that I have. I bought TDoc, I bought eHealth, I also bought a little bit of Coinbase while it kept on dropping and dropping. And I also bought Rivian. All these, I believe in the longevity of them. I believe they are great to have for the future. They're all like developing. As you can see, I'm tech heavy, whether it's in healthcare or Rivian, which is more in the car space, the automotive space. They're all like have a huge upside to them at the prices that they are now. And that's why I invested more into those. I actually have those funds already and I'm down by a lot, but I bought more now because it's at a much discount. And I'm just playing the patience game and just waiting. Well, at least at the day that I'm recording this video is Kathy Wood. She bought $3 million worth of Coinbase. I know there's a lot of speculations, news going around Coinbase right now. They even said something about the bankruptcy that they might try to take your crypto, all this stuff. But I'm not panicking against that. I think if that was to happen, that investors would actually step in and find a way to make that happen. There's a lot of laws too that they would have to go through before they actually even get there. So I really believe Coinbase for the longer term. Even though the market is down, if you had stuff, try to not sell it. Instead, try to buy more. You want to always keep buying going on the downward so that you can really experience the upper side of things. One of the things I try to do is speak to my friends about it too, just so we can have like that communication channel, right? We're not so isolated. Because I remember when I first started investing, I have that one story of that one stock I bought for $1,000. If I had held on to it, like really throughout all the COVID days, it would have been like 70 something thousand dollars. I didn't do that. And that's the first video that I recorded and I mentioned that. But you definitely don't want to sell. Like it doesn't make sense to really do it. If you keep like buying averaging down, yes, not everything is going to be a winner. But however, if you're putting that strategy and implementing it, like you're bound to succeed. Every investor, every rich person will tell you that not everything that they have or invested in were a complete success. So it's okay. So don't be afraid. Buy things that you're comfortable with, you're knowledgeable of, and industries that you have interest in. With crypto, I definitely went in on crypto as well. So my indices for crypto is the major ones, right? You got Bitcoin, Ethereum, as well as Litecoin. Those are the three that I typically look at to see where is the market, because they'll always average down. They won't react as crazy as all the other ones, even though it's very volatile. So what did I buy more of? I definitely bought more of Matic. I believe in their technology. I think it's awesome. I think it's amazing. the way that they're just speeding up transactions. I bought Doge just for the upside. They don't have any technology that I can really back up and say. And I also bought Shiba Inu for the first time. I'd never invested in it, but I'm also buying it for the upside because it's just another thing. The last one that I did buy is Cadena. KDA, because I believe in their technology. I believe in what they're doing as well. I put in a little bit more. I originally invested in them around the dollar mark and such, and I've seen a huge upside. They went all the way down to like $24 last year, and they brought that down. And I averaged around on this buy, maybe around like $2 and change. But it's okay. I'll just be playing the patient game and just waiting. But those are the only crypto I really purchased and bought. So a friend of mine had asked me, what should he do with credit cards? Many of you have credit cards and you're wondering right now, especially with the market that's down, like what should you do? Like, should you be paying more of the credit card or should you be like investing it? It's a tricky thing to really answer, but I'll give you my answer that I suggested to my friend based upon the numbers that we were working with. So his monthly payment was around $90 a month. And that's like the bare minimum payment. It was an average payment. It was above the bare minimum. But at least he'll be able to pay it off in 3 years. So he did the math and everything, but pretty much he would end up paying about $1,200 in interest when we calculated it over the course of the period of time that the credit card company had told him. So what I told him, because he had $3,000 to just pay off the whole thing, I told him do not do that. Instead, let's look at that math. Since it's only really going to cost you $1,200 in interest, I think you can make a lot more money inside of the market right now, especially the fact that it's down. Invest that money right now. You should definitely be able to double it across when that rebound really happens. Because things are at a huge discount, the upside is so much greater. I think it's less risky when things are down for you to invest. It's actually the time you really want to get in. That's why I had advised him, because what he could end up being is that he makes double the money, which means from the $3,000 investment, he makes $6,000 in a period of time. And if we just use that number, for example, there's a $3,000 gain that he had, right? $3,000 profit. So he invested $3,000. He had a $3,000 profit, in total $6,000. But let's just use the profit number because that's what we got to play around with. And if we versus that against the $1,200 it's going to cost them, because he has to now pay the $1,200 interest since he's writing it out for the 3 years, right? That's assuming he makes $3,000 in the 3-year mark that he has to pay it off. So $3,000 minus the $1,200 that it costs, it's really an $1,800 difference, right? An $1,800 difference is the pretty much the difference if he does it this route. If he does it the other route, where he pays it right away, he'll save $1,200 in interest. Versus our way, he'll save $1,800. So there's a $600 difference there, right? So the first way that I explain is that you go in, invest the money into the market, you have a $3,000 gain of profit, right? But it costs you $1,200 in interest to have that $300 gain. So you really only made $1,800, right? So you have $1,800 in profit versus, meaning you saved $1,800. So that profit margin is really how much money you're saving. But if we look at the other way, where he gets rid of the debt right now, right away, it's a $1,200 that he's saving. So that's where the $1,200 difference between the $1,800 comes from. So it's a $600 difference that he's gaining by doing the investment strategy, right? If we look at it that way. But you also got to factor in that your credit card interest that you pay is tax deductible, right? You can minus that from your taxes. And on top of that, because he spends 3 years to pay that off, the inflation of that money went further down. So really, if we do a weird math, and I'm just throwing numbers out there, it's probably ends up being like a $900 gain from $600, right? And that's just me running some numbers, just so you get the picture and understanding of why it's better to do that. But that was for his case, because I looked at how much upside he can get, how much he had to invest, as well as how much the credit card interests were. It made sense. However, it may not make sense for everybody, because if your interest is higher, then of course you want to get rid of the debt right away and you'll be able to pay it off. So those are the things that you want to look at when it comes to like doing this use case scenario. But right now, I think it's a great time to make some sacrifices and just like really try to build and invest as much as you can, whether it's crypto, whether it's stocks. Definitely diversify between the two. I wouldn't say go concentrated in one or the other. That's just me personally, my experience and how I set up my portfolio. But however you could do it, however you wish to. Get into your HSA, get into your 401k. And if you're independent out there, you have more funds to buy and everything. Your upside should be greater because you have like all these stocks available to you and everything, like I do. But those are my suggestions. I hope it's been helpful. Please consult with your financial advisor, attorney, accountant. I am not a financial advisor. I'm doing this purely for educational as well as entertainment purposes. As a full disclaimer, I have to state that. But please be on the lookout for more tips and advice. I'm just sharing this with you at this time because I felt it was very important, because it's something that many people are wondering, questioning right now. What should they do? What should they do? I hope it's been helpful. If it has, please give this video a thumbs up, subscribe, share with others. And I'd love to hear your thoughts. If you have any strategies that you're implementing throughout these times too, I'd love to hear about it. I'm always open to learn, and let's just share. Peace. Next time.